Today's agenda is on forecasting, as you can see in the title, forecasting with seasonality. Then I'm going to go to scenarios. I'm going to talk about sensitivity analysis. So some of it are sounding like big words, but you know what? Excel has in place those tools. So you'll be surprised. I hope you won't be disappointed anyway. Some people will be like, oh, these things are sounding really great. You know, they're expecting me to do something maybe a lot tougher than what I'm going to do. It's because Excel has it in place. It's just a matter of you're not aware and you keep thinking when people mention these words, they have to do something really, really like almost as if they are going to be doing some kind of coding or something complex to achieve them. No, no, no. You don't have to do anything complex to get these things that I want to show. So let's get started, right? I'm going to go to the practice file. Let's start with the time series. Okay, so maybe what I will do after the session is I will try and zip or try and share with us the practice file. So imagine that you're a salesperson, right? You work for a company. Why I'm using a sales example is when it comes to forecasting, when it comes to prediction, the people who normally are interested in these are salespeople and finance people. But then when I use examples that are finance related, people who are not in the finance background, they don't like it. They get left out. But finance people are accommodating. So if I use an example that is not finance related, they understand. They will be able to apply it. So that's why I'm using something that is sales related. So if you look at my screen, imagine that you are in charge of tracking of sales, of analysis for a company, and you have daily record of sales, right? So there's a company I'm working on a project for right now, and this is what they actually use in predicting and setting targets for their sales team. And it's because it's so practical. And the interesting thing that I'm trying to show us today is it's not just so practical, it's very easy. Does it make sense if I'm a salesperson and you are setting a target for me that has no relevance, no consideration of what I've been doing before now? It's just meaningless. You know, some bankers, that's what they say frustrates them when management gives them target. That doesn't factor in the fact that maybe the place they covered, it's above the potential of the coverage that they have been given, the deal book and whatsoever access they've been given. So without wasting any more time, when it comes to sales forecast, remember I said this can also apply to other kinds of forecasts, but then again, let's talk about what we have here. So when it comes to sales forecast, these are the usual approaches. There's what we call magic number. It is the worst. Magic number is somebody just tells you this is your target. There's no formula, there's no anything they will tell you that they use in deriving it. It's just some kind of gut intuition. It's just some kind of what they want you to do. And it's a take it or leave it. Leave it means maybe you resign your job anyway. So there's magic number. And then there is what we are talking about. There is moving average. So what is moving average? Moving average is I look at what you have been doing the last couple of days and I use that to predict what you should do into the future. If I've been selling, if I sold on Monday 9,000 naira worth of goods so let's look at it. If I sold on Monday and Tuesday, and let's say this is 1 week, maybe you work all days of the week. I sold 9,000 naira on Monday. I sold 10,000 naira on Tuesday. I sold 9,000 naira on the day after. I sold 9,500 naira on the day after. Again, I sold 10,000 naira. I sold 9,000 naira. You see, there's a pattern. So if I want to forecast into the future, the coming week for you, then I can say that I want to use moving average. So what is moving average? Moving average is always related to number of periods. So those into stocks and forex trading, they will be familiar when they say signals and they say, oh, the 30 days moving average, the 60 days moving average, the 5 days moving average. But now, forget about that one, because sometimes we use it and you don't know that that's the same thing that you are using. So here now, if I'm deciding to use, say, maybe a 7 days moving average, that means I'm looking at your last week and I'm using that your last week to estimate what you should do. So I'm using your most recent 7 days sales trend. And when you say average, it means I'm averaging it. So I'm simply saying average of your last 7 days, 1, 2, 3, 4, 5, 6, 7. So average of your last 7 days actuals. That is what I am now going to take and say I want to use it to forecast for your next week's performance. Okay, so if you look at this, okay, this is a moving average. I want to ask you, what if the company decides to use 4 days moving average? What do you think is going to change in my computation? Anybody? What do you think I'll change if it's 4 days moving average? You can unmute and speak. I just want to be sure everybody is partaking. What do you think? Yes, sir. Mr. Shegun is like you're trying to say something. Can somebody just tell me what do you think would be the difference? Okay, nobody wants to help out. I'll help myself. So 4 days means that I am going to use 1, 2, 3,
Yes.
4.
We're going to use 4 days.
Thank you. Awesome. Yes. So we're going to take the last 4 days. So that's moving average. And when people are setting budgets too, sometimes they use that. They will say, you know, what has been your normal usage? If I want to budget in our own office now, if we want to make provisions for what is going to cover office supplies, we're going to look at the pattern. So what have we been using, you know, the last couple of weeks? And then we just take it and do an average and use it to push and say, okay, this is how much we should set aside for this month. Okay, so clear. Moving average. But you know what is wrong about, or what is problematic about moving average? Moving average does not factor in what we call seasonality. So seasonality is, there might be, just as we know, there will be some days of the week that we don't do much sales because not all days are equal. If I'm into transport, obviously I should not be doing as much sales on a weekend as on a weekday. If I'm into intracity, you know, intracity means I'm carrying from Ikeja to VI, and you know those kind of movement. You might find out that you maybe make more sales during the work days rather than weekend. And you know what? For somebody doing between two cities, it might be weekends that are his own. But the key thing I want to bring out is sometimes you need to factor in seasonality. Seasonality is, there are seasons of high volume, high sales, and there are seasons of low sales. And you want your forecast to factor that in. So are we ready? I've started with on a slow note, but now let's see how you can do this. If I wanted to do this without this tool I'm showing you, it will be difficult in Excel. You will be almost writing like statistical programs from scratch, right? But then since Excel 2013, Microsoft has made life easy for us. So you know what? I have sales going back the last 3 months. I want to forecast for the next couple of days. And I want my forecast to understand the sales trend, which is the moving average. Moving average covers the trend. Are we trending upwards or are we trending downwards? Moving average clearly captures that. But then I also want it to cover seasonality. So seasonality is where it's problematic if you do not know this tool I'm trying to show us. So if you look at your Excel, after selecting the historical transactions that you have, if you go to data menu, so if you go to data menu and then you go in here, you will see forecast sheets, right? Now, if I click on forecast sheets, a window is going to come up. A window is going to come up. Let me zoom my screen so that we can see the window in a much larger way. Can you see this? Now, if I expand this, okay, I'm doing a data science kind of program. When we were to implement something like this, we have to use Python, use R, and it's not complex because we are using already developed packages. But then I always keep thinking, Excel, I just click a button and I'm done. But people who are in R and Python, they keep thinking like, no way Excel can do this. What we are doing is so, there's so much sophistication to it. Excel has decided to create a tool to simplify it for those of us who do not have head for all those complex ways of achieving the same thing that is commonly needed. So what has Excel done? Excel is asking me, okay, where do I want to forecast to? So our data ends in 28th of February of March. Maybe I want to forecast to 16th. So I'm able to set the periods I want to forecast into, right? And then you see what those programming guys will have to code. It's asking me to specify what is the confidence interval that I want. So if I look at my data and I look at the past, so I want to say with 95% confidence, based on what has been happening, this is what will happen. This is what will most likely happen, right? So that is what this confidence interval is saying. It's telling me how much room for errors am I wanting to allow. So you can say you want something that is so very, very, restrictive that, the error margin will be very small. Then you increase the confidence interval. So the more you increase the confidence interval, the more the upper and lower bounds will increase. So it will give you a bigger range of expectation. But 95% is not bad. So let's take it back to 95%. So with 95%, you are able to say, within this upper and lower bound, your forecast will lie there. Okay. So if I'm in sales, I can just give the target, the upper bound, as the target to my sales team. If I'm a sales manager, I give them the upper bound. Why? They should go and target that one. If they don't meet it, most likely, they might meet even the actual thing I am working towards. That's life anyway. The same way those in project management, they will pad it with some extra days for allowance for things delaying. So you too in sales, you don't give your guys the same target that will make you meet your target. Otherwise, if one person slacks, you will not miss your target. So sometimes you want to give them something more. And so that if somebody falls below, he falls sick, he couldn't go and do his sales round that day, that is not going to jeopardize you getting your own bonus or you failing your own target. So I'm just telling you what this stands for. And you know what? Detect seasonality. Can you see the seasonality we are talking about? Maybe we always have low sales on Sundays. This will remember in our data that whenever it is Sunday, you should adjust for that low sales. And if it's a monthly kind of data, maybe we are always having low sales in December. Maybe people have traveled and maybe we cater to working class guys. Most of them have traveled to village or they are just not consuming the kind of things that we sell during December. So it will take note of that okay, there are these months of the year when you typically have low sales, and there will be months of the year where you also have high sales. What is happening to my screen? So there will be months of the year where you have high sales. So I'm noticing that my screen is showing the wrong one. Let me just reset it to showing the right one. Can you see my screen? Can you see particularly the Excel? Okay, back. I think I can notice that. that is showing again. So seasonality, this is it. You want to detect it, or you know for certain your seasonality. You can set the month manually. I can set the period and say, you know, my seasonality always happens on the 9th month or on the 2nd month, or, you know, by your data anyway. So it keeps going in multiples of that. So I'm going to let it detect automatically. Then what should happen to missing data? So if there are dates that we do not get information, do I want it to do interpolation? Do I want it to just put zeros on those dates? So you can set it. You know, these are some of the things that when people tell you that this is what they want, you start thinking Excel cannot do it. But Excel can. It's just because maybe you've not really looked out for this tool that I'm showing us. Okay, so I'm going to also show us what should it do when there is duplicates. You know, when somebody kept the same month twice, should it do an average? Should it sum them? You know, so in this case, I might be okay with average. So whenever there are duplicates in my record, meaning somebody recorded for the same day, maybe 3 or 2 times, should it add them up? Should it average? So average is good for this one. If I know that if that happens, that means it's just unintended error. And there might be times where you are collating data from multiple stations, multiple people. And so those duplicates might not really be duplicates. It might just be values from different branches. Then you will tell it to sum them up, so that to sum them up and use that to know exactly what your total sales was for that period. So I'm going to go a bit faster. I'm okay with setting all of these. And I will do create. So the moment I do create, you will see it will do a graph for me. Let me zoom in on the graph. So it has done a graph that's showing me what my sales is going to be like for those next couple of periods. And it's also drawn for me the upper and lower bound. Okay, so these are like the confidence intervals. Okay, so there's a formula approach too, but I don't want to show us a formula approach because this does way better than the formula approach. There has always been. Oh, okay, Mr. Yomi, yes, I'm going to do a recording. So we're actually doing the recording. So I'm going to share the recording. Unfortunately, it might not be out today. So it will be out most likely tomorrow. He's asking about recording of the session that I joined in a bit late. So in case anybody too has the same concerns, there's going to be a recording that I will share. Okay, so I was mentioning that there's a formula approach too, but I don't want to, because to be sincere, I use this more than the formula approach. The formula approach, it will not draw the graph for you. You are going to have to take care for yourself, interpolation, missing data. So this one, if this works fine for what you want to do, I recommend you doing this without having to do a formula. Okay, so but maybe just for mentioning sake, if I wanted to do a formula, right, there's a formula called forecast. So there's a formula called forecast, and as you can see here, exponential time series, and that's what we are doing. We are doing a time series that can take into consideration. You can see here seasonality. So all those things that tool made possible for us to select. This one is going to ask you for you to put them in. So that's why I said I'm not going to worry about the formula, because the formula, the other one is nicer, if you ask me, than the formula, or easier. Okay, so I want to move on now to another one. So this is a forecasting with seasonality. Okay, anybody has a question before I go to the next, which is scenario management and sensitivity? Any questions at this juncture? Okay, so if no questions, I move on. Okay, I move on now to a different example. And here I want to tell you about the planning tools that Excel already has. Okay, so think about it. When you talk about planning, when we talk about planning, there are things you need to factor in. The fact that, number one, we all plan for the future. Have you seen someone who is planning and is planning for the past? No, we plan for the future. So planning for the future automatically means that, maybe I should write that in a separate line. There will always be some level of uncertainty, right? So how do you handle the uncertainty? So that's what I want to show you, some tools that Excel has in place. So there will be levels of uncertainty, and then always there will be inputs, and then there will be your desired or interests, the kind of output you are interested in. Did I say interested output? Desired. Let me just write it. There will be outputs you are interested in. Oh, okay. Someone says he didn't notice. Let me try and read it. So I have also noticed, I haven't noticed very well where it did go. I just saw it click somewhere in the menu too, and then clicked an icon named forecast. I can quickly show that one again. So what I did was, in fact, I'm going to close this file. I'm going to close it without saving. I'm going to open it again. I'm going to open it again. Remember I said I'm going to share the file. So where did I click? So this is just me answering the question Augusto is referring to, that where did I click and all of that. So see, I selected the data. I went to data menu, right? Right in data menu, you will see forecast sheet. I clicked on that. That's where this came up. And then all these options I was talking about. And then I changed some options, and then I clicked on create. So the creating is what created this that you are seeing as the outcome. So just wanted to restate that. Maybe I should save this as a solution, or what should I? Okay, maybe I won't save it as solution so you can practice it from scratch yourself. So back to planning, right? So these are the three key things that whenever you are planning, you need to know as the underlying concerns. So what are the things that you have in Excel? What are the things you have in Excel to help you to handle planning? Okay, so the tools we have in Excel. Planning tools in Excel are the forecast tool I showed you. If your forecast is going to feed into your plan in any way, if you have forecasted this and then you want to use that to apportion resources, then forecast tool, definitely, which you have done, you can add it as part of the tools. But then there's also goal seek. Okay, so goal seek is another tool. There is scenario manager. There is also data table. So as much as time will allow me to, I teach slowly because I don't have anything to rush. If I don't finish it, I can always finish it in another session. So you might notice that I'm talking a bit slower than maybe when we have guests. It's because maybe the guest needs to cover what he has planned. So let's go to goal seek, right? What do goal seek help you to do? As the name implies, goal seek is to determine the inputs, the right inputs to get a desired output, right? I'm going to underline and make in bold this, and I'm going to underline and make in bold this. So when we talk about goal seek, you need to have the output you desire. You need to know it. That's why it's called a desired output. And then you need to have already in place a breakdown of how your inputs feed into your output. So once you have those two things, then great, you'll be able to use goal seek. So let's walk through two examples I have in here. So I have two examples I want to quickly demo with. So imagine that this is looking busy, right? So let me just copy what I need out. I'm going to copy this. I'm going to go to a different Excel file, paste, and let's use this for illustration. For those who have done my training, this will be like a refresher, and that's what we keep saying. We pick a topic a week so that you remember. So if you remember it very well, then sorry that it might be like a waste of your time. So let us look at the situation. The situation is that someone needs to take a loan, right? He has approached a lender, maybe a bank, and these are the conditions they've given him. We're going to give you this money for 5 years, but you know what? We're going to give it to you at 21% interest rate. So if I know that, then every year I will need to repay a fixed amount to cover both principal and repayment. Okay, so there's a formula in Excel that allows me to capture for a loan that I'm going to be paying the same amount to cover interest and principal, right? So we call that variable principal. Variable principal, but fixed amount anyway, fixed debt service. So let's not worry too much about the formula. It's the concept, right? So I'm going to plug in the formula that allows me. That's what salary loans are computed by. Salary loans, personal loans, that are computed using this approach. That's why they will tell you, you know what, we are going to spread buy a car now, but instead of you paying down, we will spread the payment. You'll be paying, maybe 500,000 naira, maybe 200,000 naira every month for the next 12 months. So what they are doing is they have combined the principal and the interest together as one constant payment. Yeah, constant payment is the word. So this is the formula to do that. This is the formula that lets you know what is the constant amount you'll be paying per period for the loan. So for a yearly 5-year loan, the rate is this, 21%. The number of periods is this. The present value of the loan. So it's something that you are taking against you. So it's something that is negative against you. So that's why. And then future value, you have to repay everything. So there's going to be 0 at the end of the 5 years. You must have repaid all of the money you borrowed. The type of the loan, end of period or start of period. Well, end of period is the common one. So let's just leave it as end of period. You can omit it. Normally, end of period means you borrow the money now, you start paying at the end of the period. So if it's a yearly loan, you pay at the end of year 1, you pay at the end of year 2. Whereas start of period means instead of them giving you the 100 million naira, they give you 90 million naira. Why? They started removing the repayment right from the beginning. So that is not that common for many loans structure. So I filled in the formula. I'm going to click on OK. And so this tells me that I'm going to need to start repaying 34 million something every year. So if I look into my accounting profile, I check through my financial statements and projection, and I see that I cannot afford to pay that amount. Maybe the only amount we can afford to pay is 28 million every year. Okay, so I'm a salary earner, I've taken a salary loan, and I know that based on my salary, maybe I get 700,000 naira a month. I can only pay, and if I know how much I spend monthly, maybe I spend like 300,000 naira monthly. So that means out of 700,000 naira, 300,000 naira I'm going to spend, and so I'm left with 400,000 naira. So any loan that will require me paying more than 400,000 naira a month, it's above my power, right? So how can I know what interest rates? So I want to, this is my desired output. This is my desired output. I want to know the right input. In this case, the right input is the right interest rate to go and negotiate for, so that I will achieve my desired output. To achieve my desired output. So are you getting it? So this is what goal seek allows us to do. So I'm going to quickly implement right now. I'm going to tell Excel that I want to know what interest rates will allow me to pay 28 million naira. And I don't want to do trial and error. I don't want to come here and start changing it to 20% and start changing it to, and I should be doing trial and error. I want Excel to tell me the exact right inputs. I should start applying what I learned from the financial modeling. The right inputs to achieve the desired output. Okay, to achieve the desired, I will have to go create, there's even an output one, so I'll just modify it. So are you getting it? Maybe I even just modify it right now. Modify it. I have Victor to thanks for this. If you missed from the financial modeling session, you won't understand what I'm doing. So let me use, I'm a blue someone. Blue is my favorite color. Awesome. So, right. I go to data menu. I go again to that place where we picked forecast sheet. Beside it, there's what if analysis. And right now I'm doing goal seek. So I pick goal seek. When I pick goal seek, a box is going to come up, right? And then it's exactly what we are trying to do. It will try to achieve for us. We want to set the output cell. The output cell in this case is my payment amount. I want to set it to what value? The amount I can afford to pay to my desired output. My desired output is 28 million. In Excel, you can do 28E6, E the number of zeros. Okay, so I set it to my desired value. This 28E6 you are seeing is 28 million. I don't have to be counting the zeros. So that's a shortcut I'm showing us. Okay, then by changing what cell, I want to know the right input. So by changing this input cell, changing this, are you getting it? Is this clear? So that is it. This is what you said. Your output cell to the exact desired value, right? And then the input cell. Clear? And I do okay. And Excel is going to be doing, you will see it work, it's going to be faster than me and more accurate than me. And it's telling me exactly, can you see here? Can you ever be this accurate if you are doing this manually? No. Okay, so this tells you in very accurate term what you need to aim for you to achieve your desired output. Okay, so I hope this is clear because I have a question for us. Clear? Anybody having any issue with what I've said? So nobody's having any issue. Okay, clear. So here is my question for us. Okay, should I use something that is not, okay, I'm not going to use something that is again looking like finance related. Let's use what everybody cares about, salary. Okay, so let me grab this and just take it out from here. And let's go face it here. Okay, so here is the story. You are the HR for company ABC. And there's actually a company called ABC Limited. So you're the HR of ABC Limited, right? And you have your salary structure already. So if you are paying someone 10 million naira, then you know that 8% pension is 18%. But well, your own contribution. Anyway, let me just put it at 18%. However, you want to do the sharing it off, it should be 10% employer, 8% employee. But let's just not worry about that dichotomy and just put the absolute amount here. Then let's say this person's payee category, or there's a formula that generates the percentage of your salary that you are going to have to pay to states as his payee. So let's just put 24% here. I know it's a progressive rate, but simplification for our progress. Then maybe there is an allowance that is always 10% of your basic salary, and that's how we come to the gross salary. Okay, so imagine that there's a salary scale for this job role. There's a role that you are interviewing someone for. You are interviewing someone for a role. You are interviewing, let me get a name from amongst us. So let me just look at our names and grab somebody's name there. So you are interviewing Mr. Abib. Mr. Abib. Okay, so here's the question. Management has said this is the salary scale for this role. You are interviewing Mr. Abib. Mr. Abib is asking for net salary. Say, see, I don't care gross salary. What I want is my base salary. My net salary should be 10 million naira. That is what is asking when you're asking what is salary expectation. I want my take home to be 10 million naira. I don't care what you do about allowance, but when at the end of the month, when I get the payment alert, the amount I want to see in my alert is this. So 10 million naira. You know, some companies can put a naira value to benefits they give you. Maybe if I'm a manufacturing company and we normally will give you some product, they put a naira amount to it and they add it in the salary scale. So I'm saying, okay, that is good, but I don't care. I care about what it's my bank statement. So my question for you is this. If you are to now counter his offer and you want the gross to be exactly 14 million. So he has asked for 10 million. 10 million is making it to be a gross of 15.2. You want to give him a counter offer. Counter offer means you want to find what net salary you should give him that will make the gross exactly at the maximum of the scale, which is the 14 million. Can you direct me what we should do? Question number one, can go seek work? What do you think? Will go seek work? Anybody? Do you think go seek will work?
Sorry, your question again. Your question again.
Okay, my question is, Mr. Who is asking me what the question is again? So I can personalize the question. Okay, so Mr. Ladi, you are the HR of company ABC. You are interviewing Mr. Habib. So you've talked about many aspects of the job, and then you've got into Mr. Habib, can we know your salary expectation? Mr. Habib is saying, I want my net salary to be 10 million naira. Now when you put in that 10 million naira here, this is what comes out. Let me even change the question. Let's say it says, I want my annual take home to be 11 million naira. You already have a template. You just plug in the money he has asked. And instantly the template is showing you that his gross salary is going to be 16.72. Management, already you are aware that the maximum for that job role, the maximum gross, the total personnel expense budgeted for that role is 14 million. So gross must not be more than 14 million, right? So question is, can go seek help you to know? You are supposed to give a counter offer and say, Mr. Habib, I've heard what you've said, but what if we offer you XYZ amount? So that offer you, I want to tell him, what if we offer you an amount that will make the gross exactly 14 million that I know is the maximum? What do you think? Can goal seek work? Can goal seek work?
I think so. I think so. Yes.
Awesome. So do you want to direct us? Well, because of time, you are correct. So I'm going to quickly use goal seek. So what do? I go to data menu. I go to data menu and I go to what if analysis and I go to goal seek. So if you remember what I said about goal seek, it's all a concept of desired output and desired input, right? So what is my output cell? I want this, my output cell, which is the gross salary. I want it to be exactly 14 million. By changing what cell? By changing the input cell, which is the net salary. So I want Excel to find for me the right input, the right net salary to offer Mr. Habib that will make my gross salary exactly the maximum, which is 14 million, right? Clear? And that is it. And once you do okay, it does its work, and it says, Michael, just tell Mr. Habib. So I will be like, Mr. Habib, what if we offer you 9.2 million annual take home? And that is it. So you see you're correct. So the takeaway from this is goal seek is to help us whenever we have a situation that you know the output that is desired. Okay, you just want Excel to tell you the right input, and you must have done a kind of calculation that relates the inputs to the outputs. So goal seek will now be like working towards the answer for you. So clear? Great. So goal seek, that's what it does. Now let's move on to another one, which is scenario manager. What about scenario manager? Now scenario manager allows you to capture different input scenarios. So scenario manager is not a case of I know what the output should be. Scenario manager is not concerned about a predetermined output. Scenario manager is concerned more about the robustness of your inputs. So you want to say, instead of me using one type of input, I want to be able to put in my planning different scenarios, best case, worst case, base case, different scenarios. That's your idea, to capture different input scenarios. So now that I've explained that, let's go check out an example that I have. Again, for those who have done our training, it will be as if I'm repeating the same thing. So it's a good opportunity for you to recollect if you have forgotten. I'm just going to wipe off this one so that you don't get distracted by what I have here, so that we all can focus more on the thing I want to explain right now. So I'm into training. So when people are talking about they want to do a factory, they want to do a real estate project, I will be quiet because I don't know much about it. It's whatever they tell me that I put into Excel for them. But tell me you want to do a training. Before you say A, I will say ABC for you because I know that one very well, right? So let's see how, if I'm creating a project that is related to training. So we want to do a training in Dubai, in Abuja, in Port Harcourt, in wherever it is. So we've cost the hotel. The hotel conference room is 600K. Feeding per person is 12.5. Training materials will cost us 30. So these are my inputs, right? Training certificate is 2K per person. We are going to do a prize for best participants. So yes, and then I continue with my inputs. We think we should be able to get 40 people. We intend to charge them 100,000 naira, per person, right? And so with this, I can start using my input to calculate towards my output, right? So these are all of my inputs. In fact, I can just drag this here and say these are my inputs and call this project inputs. Okay, so what will this be? This will be my workings or computations, right? Maybe I will just separate this one and say this is my output. So in some people's project, this can be different sheets. A sheet for input, a sheet or one or more sheets for the computations, the workings, and then another sheet for the output. So it's just a matter of how complex your project is, but the concept is the same. Okay, so let's look at this, right? With these inputs, right? In fact, so that you don't keep thinking why is one input colored, let me just remove the color from this one, and then we can know why we can work to it together. My connection of all of these will be total feeding cost will be how many people we get times how much to feed one person. Again, another input is the conference room, is a fixed expense. Training materials similar, how many people we get times how much to do for one person, right? Certificate cost is similar, how many people we get times how much for one person. Prize award, only one person wins it, so I can just go pick that award amount. Great. And then from there I can get what the revenue is going to be. Revenue is going to be how many people we get times how much the pay. Okay, and then what other thing? Total cost is now going to be the summation of all of these my cost breakdown that is already factoring in all of the people and how much we are spending to cater for them for this training. And then VAT is now 7.5. I need to update this. Okay, so VAT is 7.5%. So I take the revenue and then say I multiply by 7.5% so that I have the cost, the VAT line out. But the truth is, if this thing is a VAT inclusive, then let me not complicate things. Let's just leave it this way. So contingency, whenever you are doing projects, right, you want to allow for things going beyond your plan. So in CAPEX, in some project financing, they even do it as a percentage. They will say maybe add 20%, you know, to the OPEX for contingency or to the CAPEX for contingency. But anyway, we are going to have to do contingency of 7%. So that's going to be like, in this case, I'm doing it against revenue. I'm going to say, okay, we are going to take it that 7% of our revenue we're going to set aside to cover unexpected costs. Okay, so this is me fleshing out the entire project, right? So now if I do this, I can now know what is our gross profit. You know, are we even going to have any money to take back to the company after this training, you know, before we start talking about people's salary and all of the rest? So gross profit, you know, after taking out all these direct expenses, what do we have? So this is really profitable. But if you remember what we said, that scenario is all about capturing different scenarios, being robust in your planning. Okay, so if this is something that you are going to effect, you are going to have to pay the hotel. When the hotel people call you and say, oh yeah, come and deposit, otherwise we cannot guarantee, and you need to print flyers and you need to do, and you are going to put the date on the flyer. Before you go and put the date that the hotel has not even locked down for you, you will have to pay the hotel, right? So when that begins to eat home, then doubts come up. You start checking, am I being realistic? So let's look at our input. If you look at our input, hotels tells you that don't worry, if you pay, you know, before next week, nothing will change the price. That price is fixed, so they've guaranteed the price for you. Feeding is also fixed, right? Training materials, you know how much, maybe you've even printed it already. It's already been, it's a realized expense. Certificates, you already know exactly that is the 2K you are going to spend. Price, you've earmarked it that 100K makes sense. Number of participants, now you don't know. It depends on how well you do marketing. It depends. There are question marks about these ones. It's not fixed. You don't know for certain. Cost fee, people will negotiate. You know, there will be back and forth. The salespeople will come back and tell you, somebody wants to say they want to send 5 people and pay something. So it will be nice to be able to vary it and see under different scenarios what will pan out, right? So that's why I have colored these two as the kind of inputs that will be changing, or that we would like to create different scenarios around. So I don't want to be rigid and say this is what it will always be, right? So I want to say I want to be able to capture different scenarios for these two inputs. So ready? So how do we do that? I go to data menu and I go to scenario what if analysis. Let me zoom my screen. So I go to data menu, boom. I go to that same what if analysis where we saw goal seek, but this time around scenario manager. So I'm in scenario manager, right? I'm going to delete all what I've done because I want to start from scratch. So when you go to scenario manager, this is what happens. Blank. You start adding the scenarios. You can add up to 255 scenarios, right? So let's start. I had scenario. So I can be like, let's do a best case scenario, or let's do MD scenario. MD is saying this is what we should go and achieve. So let us call that scenario MD. He's the one talking, but he's not the one on the field, right? So let us not argue with him. MD scenario. Now, salespeople are on the field. The field guys are saying these are what so maybe this is interesting. Let's call it that. So let's say instead of best case and MD scenario. MD scenario. Okay. What MD is saying? MD is saying you guys go and get me 40 people, 100K. Okay. That's how much you charge them. MD scenario, 40 people, 100K per participant. I had another scenario. So the sales guys. So the sales guys are telling us that, bros, nobody wants to pay that amount. The economy is not smiling, blah blah. So I call this sales guy scenario. So they are saying, see, we think what is realistic is get you planning that is 30 people you will get to. We can get 40 people and they won't even pay 100K. If we are lucky, they will pay 75,000. So we do that. And then we now had and say the people that are going to release the money for us to go and do this. So let's call this the finance team scenario. So the finance guys who are going to approve whether this is a project that we're going to release fund for or not, they are going to be much more picking holes in whatever you are saying. So they will not be as enthusiastic or optimistic as everybody's. Field guys will be thinking because they can talk. Field guys are always naturally, should I say, optimistic. Otherwise, they won't be field guys anyway. MD is the chief sales officer anyway. He wants them to even do the unimaginable, this magical. So finance guys are saying, okay, no problem. But let us even say like a kind of worst case or looking at the patterns of what has happened. What if what you guys are only able to get 20 people and they are paying 50K? What will that happen? What will that have as regards our outcome? So I'm going to click on OK when I'm done. You can add up to 255 anyway, but I'm okay with these three. You can keep adding more if you want. So you will now say you want to see the outcome, which is summary. So when you click on summary, right, and then this comes up, it's going to ask us, you want to see the effect of all of these on what? I want to see the effect on our gross profit. I want to see what the gross profit will be based on these different scenarios of inputs. So that's what I'm going to do. I click on OK, and it's going to do its work. And instantly it has created a new sheet, an entirely new sheet. And in this new sheet, it has done for us what we have asked. So it has created MD scenario, sales guy scenarios, and the finance team scenario. And what you are looking at here is the participants. In fact, let me just copy and paste so that I don't spend too much time typing. If we had used name cells, we will not be needing to type, but that's, I don't want to complicate things for us. Let's just learn one thing in its own space. So this is it. Number of participants, if you get 40 people, if you get, so with this now, you can be able to present to all stakeholders, put MD in one room, put the sales team in the same room, put the finance team in the same room, and let them see. MD, when it's your scenario, this is what happens. We get 2 million error. Awesome. You know, 1 day training, 2 million error. Good. Maybe we should be doing it every week. Sales guys, with the kind of target you people want to commit to, that you can get us 30 people at 75, this is what will happen. Though MD is insisting this is what you should do. Finance guys, you guys that are saying, you know, this is what you think might happen. This is what the outcome will be. So essentially, you can even turn this to like a best case scenario, base case, worst case. So that is what scenario manager does for us. Clear? Now I'm not going to ask you whether you understand or not. You will watch the video if you don't understand. I'm running against time. So I want to do the last one, which is the data table. Okay. So now let's think about what data table does for us. Data table allows us to create sensitivity analysis around 1 or 2 inputs. So I'm going to underline or make in bold. This is critical that you remember them. It cannot do more than 2 inputs. And what it's essentially doing is sensitivity. What's the meaning of sensitivity? How sensitive is your output? Not just how, but showing you the outcome. How the outcome is varying, you know, based on changes in your selected inputs. Okay, so how is Nigeria's FX reserve changing with oil price? You know, so those kind of things anyway. But because of time, let's just go do it. So I'm lucky that I have 2 major inputs here. So let us create sensitivity analysis around these 2 major inputs, right? So how does it work? You are going to say, one input changing. So let's say the number, how much we are charging, 10,000 naira. €10,000, 20,000 naira, you know, so let me just keep up the pattern up onto, let's say we know that we can charge above 100. So one input, which is the cost fee, how it is changing, right? So the cost fee, I can just draw a line to show that this, great. And then another one for what if we get 5 people? What if we get 10 people? So you get the pattern, right? What if we get different numbers of people, right? So this one is relating to the number of participants. Okay, so one thing about data table or this scenario analysis is I need to specify ahead what is the output I want to keep track of. I want to keep track of the gross profit, which is this one. So the interesting thing is you need to position that your output exactly at that spot where the 2 inputs will have coincided. So the number of people like this, the amount we are charging like this. So where the 2 will have, you know, intersected, which is where I am here, that's where you specify your output that you want to simulate different inputs for. You want to check sensitivity around. So how is our gross profit going to be changing based on changes in the number of people we get and based on changes in the amount we charge them, right? So once I do this, I select the entire table. I go to data menu. I go to what if analysis. I go to data table. So once I go there, a small window comes up. Why I say small is you'll be surprised, like, why is he asking me just these 2 things? It's because you normally do the work up front for data table. So this tool is data table helps us to do sensitivity around 1 or 2 inputs. So it's going to ask me what is the input that is being represented on the row. So all these things I have on the row, like this row input cell anyway. So what are they representing? They are representing the number of participants. In my original model, this is what they are simulating. They are simulating how many people we get. So likewise, for the column input cell, these column values, the things that I see here, they are capturing what? They are capturing the cost fee. So with these two information provided, it's going to get to work once you click on OK. So instantly it goes to work so that it will be easy to show. Let me just do a comma separation on the outcome. So I'm going to pick all of these and do a comma style on them so that we can see for ourselves what has happened. So you see it's showing me that, in fact, I can quickly put a conditional formatting and say anywhere that we make a loss. So any combination that is a loss means we are making less than 0, right? Any combination that is less than 0, you should put it in red for me. Okay, so voila. Instantly, I begin to see our profits making combinations. And more importantly, I see that which one plays a larger role? I think the price plays a much larger role than the number of people we get. Because if you look at it, it doesn't matter the number of people you get. If you charge low, if you charge 50K, if you charge 40K, okay, all of these prices, you will still be making losses. But the moment you start charging good enough, by the time you get 15 people, you're already making profits. So anyway, it helps you to now plan better as regards your pricing, as regards the marketing strategy you will use. Maybe you, first of all, you price it high, go and try and get, because if you price it 100K, by the time you get 15 people, you are making the kind of profit you are making when you get 15 people 100K is even more than what you make when you get 40 people, the entire 40 people at 50K. So somebody will be thinking, oh, maybe you half of it now since you have half the price. It's a lie. It's not that working that way. If you get 20 people, which is half of that 40, you are even making a super profit, more than times 2 what you will have made for 40 people at half the price of 100. So I've come to the end of my session. So these are the planning tools that Excel has put there for us so that we don't suffer unnecessarily. Yeah, Mr. Ladi, yes. Are you talking to us? Okay. I think he does not know he's not. So anybody has a question? Any questions before I wrap up the session? So if
Mr. Mike,
So Mr. Mike, are we getting the exercise file?
Oh, the file. Aha, great. So let me just save it and send then. So I'm going to just control save.
Thank you.
You're welcome, sir. So I'll just call this planning tools in Excel Office 20. Today is 14 March 2021. Let me save it. Then let me close the file so that there won't be any errors when you are trying to access it. So I'm trying to upload it so that you can have it. So while trying to upload it, let me do small marketing. We have a session coming up in less than 1 hour's time, and I don't want to miss it because it is the how do you say, the buru of Power BI. Oh, Fawaz is asking, can you explain the row input and column input again? Okay, once I do the upload and I open the file, I'll try and explain again. So I don't want you to miss this session. Please sign up.